What is a foreign exchange market? I suggest replying to the following question together. Why is the foreign exchange market the lifeblood of the global economy's circulation system, which is vital for international economic activity? It is common knowledge that there is no unified global currency which could be used in all countries. Therefore, there's been the need for continuous foreign currency exchange. It was necessary to establish an efficient settlement system for corporations, export and import companies, commercial and central banks, as well as for settlements between countries. This need led to the formation of the unified telecommunication network that facilitated exchange transactions for millions of currency buyers and sellers 24 hours a day, anywhere in the world. The worldwide currency exchange market is called Forex, foreign exchange market. This market was set up in the early 1970s, since the time that the Bretton Woods system refused fixed exchange rates and transitioned to free-floating currencies. This historic event enabled the evaluation of the currencies of the world's leading countries. Currently, Forex unites 4 regional markets: Asian, European, American, and Australian. Exchange transactions occur during the entire working week. Trading opens on Monday morning in New Zealand and closes on Friday evening in the USA. However, Forex is not a conventional exchange. To some extent, Forex resembles the Internet, since it does not belong to anyone and no one directs it, does not have a uniform center, and it does not have a specific place for trading, unlike currency futures and exchanges. Trading is carried out by phone and via electronic trading terminals simultaneously in hundreds of banks all over the world. Several $100 million are bought and sold within seconds through a huge network of currency dealers and distributed in all the leading global financial centers, which are interconnected by advanced communication systems. This is the bottom line of the so-called currency trading. Major Forex currencies are US dollar, euro, Japanese yen, Swiss franc, and British pound sterling. These are the major currencies of international settlements. Any country seeking to trade Forex must be strong. It needs to be a well-developed economy which has also explicitly fulfilled its financial obligations. At present, the dollar is the main reserve currency in the world. The establishment of the foreign exchange market triggered a new business based on making profits from the differences of exchange rate and under the condition of free and continuous floating of currency rates. Initially, deals could be closed only after being actually done on trading floors. The development of telephone communication made it possible to introduce teletrading. Later, the Internet appeared and new centralized communication systems were developed. When Internet technologies became widely accessible and popular, Internet trading services were created. Therewith, the profession of a trader gained more liquidity, financial markets gained popularity, and currency trading on Forex by individuals was already perceived as a serious and prestigious business. Currently, any person may act as a Forex trader regardless of their location, since the only thing required for transactions on Forex is Internet access. It is possible to start a trading career at any age, while previous work experience and education level do not affect traders' success. Millions of people, individual traders worldwide, are carrying out Forex transactions and make profits equaling many hundreds of thousands of dollars per year due to exchange rate fluctuations. Foreign exchange market history. Knowledge of the foreign exchange market background provides us with valuable assistance in understanding the mechanisms by which it operates, the main reasons for changes to the exchange rate, and consequently helps to forecast the market's changes. In one form or another, money existed as early as the times of the pharaohs. In the ancient world, currency exchange transactions were based on conversion of gold and silver coins from one country to the coins of other countries at exchange points. A common scale was an important attribute of this exchange. However, this system gradually came into crisis when some rulers and influential people began to add base metal to gold and silver coins. For example, copper, tin, etc. Another acute need then appeared in another form, money in a form other than coins. Currency exchange transactions evolved. And finally, international treaties led to the establishment of the international monetary system. In 1867, gold standard, Paris monetary system, was adopted at the Paris Conference. It enabled simultaneous circulation of gold coins and banknotes, free conversion of banknotes into gold, as well as free export and import of gold. Paper money was a portable means of payment, simplifying currency trade and encouraging economy prosperity. However, inflation during World War I made it impossible to maintain the currency conversion into gold and led to the collapse of the gold standard. In July 1944, the Bretton Woods Agreement was signed, which introduced dollar standard. The currencies of 44 countries were tightly related to the US dollar, while the dollar was pegged to gold at the rate set in 1934, $35 per troy ounce. Gold and reserve currencies, the US dollar and the pound sterling, were adopted as international money. The above conference in Bretton Woods also led to the establishment of the International Monetary Fund, IMF, and later the World Bank was founded. Nonetheless, this turned out to be not as simple as it seemed. In the 1960s, weaknesses of the system were first found. Specifically, the tendency of inflation acceleration emerged and spread over the USA. The market price of gold exceeded the fixed value, and the USA could not maintain it artificially. August 15, 1971, U.S. President Nixon ended the existing link between gold and the dollar, and the American currency was deprived of its security. In December 1971, it was decided to devalue the dollar. It was the first but not last decision during the post-war period. The Bretton Woods system had facilitated many countries during the war. However, since this system was not based on the market principle, its collapse in 1973 was inevitable. All the aforesaid led to the advent of new market relations. Formally, the new monetary system, including the transition to floating rates, was stipulated in the agreements reached at the Jamaica Conference in Kingston. The amended International Monetary Fund statute no longer set fixed rates of world currencies to gold. Thus, the Bretton Woods system was replaced by the Jamaica monetary system in 1976. Today's market relations and international economic activities are based on this system and cannot function without it. Soon after this, the basics of the foreign exchange market were established. What are the advantages of Forex? Over the past decades, Forex has developed into the largest financial market in the world. Unlike other financial markets worldwide, Forex features the largest volume of trade, the lowest cost of deals, and the fastest money flow. This is the only global market that is active 24 hours a day, 5 days a week. Its liquidity equals several trillion US dollars per day. Compare, daily turnover of the American Stock Exchange is approximately $300 billion, and equity capital is $10 billion. Currently, Forex transactions are the main source of revenue of the leading international banks. For example, the largest Swiss bank, Union Bank of Switzerland, UBS. In 1994, 80% of total bank profit came from Forex transactions, and only 20% of total profit was from credits and trading in securities. Opportunity to operate on the financial markets of Asia, Europe, and America has become available thanks to their union in one single global communication network. High profits can be made with relatively low deposit. George Soros's Great Britain pound Deutschmark deal was a bright milestone, as in over 2 weeks it brought $1 billion net profit, making Soros, who was not then well known, a famous trader. Myths about the foreign exchange market. The first myth is that all Forex trading is similar to a casino game. Players bid, some win, while the others lose. Forex is not a casino and does not have anything to do with casinos, as exchange rate fluctuations are based not on accidents, but on serious economic factors. Firstly, the rate of one currency to another depends on the respective national economic indicators. Secondly, it is determined by the preferences and expectations of market players. Thirdly, Forex may be forecast, since it is subject to specific analyzable laws. Negative and skeptical attitude to Forex trading is expressed only by those who have never worked on it, or by those who, having tried once and treated it carelessly, wishing to make a fortune immediately. Direct work in the market changes this attitude, as its analysis highlights more objective features than accidental ones. The second myth is rather a misstatement than a myth. It is related to the idea that the profit of some people may be made only by the loss of the others. Let us try and elaborate on this misstatement. Only a part of Forex transactions are carried out to make profits on exchange rate difference. The rest are large groups of players for whom short-term world currency rate fluctuations are not significant. This group of players uses currency exchange transactions for other purposes. Major customers for these transactions are export and import companies. Selling their goods abroad, they receive the national currency of the country where they perform sales. To invest this money in production, they need the national currency of the country where their production facilities are. Upon instructions of these companies, banks or brokers carry out the conversion. Similarly, multinational corporations pay the salaries to their employees abroad, while pension, investment, and hedge funds that manage securities portfolios abroad, issued in multiple currencies, also continuously need currency conversion. The public also contributes to the process when selling or buying goods abroad, getting salary abroad, and then converting, or just preferring to keep savings in specific currencies. Thus, they automatically become Forex participants. All these market participants continuously create huge supply and demand. It is necessary to remind of central banks, which regulate their national interest rates, maintaining national currency stability by interventions. National currency rate regulation, managing national and foreign currency reserves. The most influential central banks are U.S. Federal Reserve System, European Central Bank, Bank of England, and Bank of Japan. Any action of these banks considerably influences currency exchange rate changes. The third myth is the misled belief that in order to trade on the Forex, it is not necessary to spend a lot of time and a lot of research is not required. In other words, buy at a lower price and sell at a higher, and you'll be a millionaire. Indeed, today anyone may enter the Forex. However, only those who make the best use of their knowledge and data analysis skills will succeed. It is not easy to earn money on this market. It is not a lottery or a game, but serious and tough work. It is a requirement to learn a lot and continuously improve your knowledge and skills. It should be borne in mind that besides you, there are other players on this market: commercial banks, central banks, currency exchanges, international companies, investment companies, broker companies, and millions of individuals. Their motivations and overall behaviors determine market trends. The universal rule for a Forex trader is that he must be oriented towards the expectations and attitudes of the majority of those participants. Samples of Forex transactions. Suppose that you have $1,000 on your trade account at UBK Markets. Owing to the selected leverage provided to you automatically, you may trade in volumes that are many times higher than your trade deposit. Having carefully analyzed the current situation on the foreign exchange market on the selected currency pair, and having studied analytical materials, you've come to the conclusion that in the near future, the rate of euro to US dollar is going to rise. Therefore, based on this conclusion and having the leverage, you purchase a specific amount. For example, 10,000 euros at 14,230 US dollars at the rate of 1.423. Sometime later, the rate of this currency pair rises to your goal, and the new price of euro to US dollar is 1.435. Accordingly, you make a decision to close this deal. Sell 10,000 euros at the new rate of 1.435 and get 14,350 US dollars. That is 120 US dollars more. This is your net profit within one trading day. Consider another example that involves a larger amount. Suppose that you have 4,000 US dollars on your trade account. You still have the leverage. Having selected the currency pair, US dollar Swiss franc, and having studied analytical materials, you've made a conclusion that in the near future, the rate of the US dollar to Swiss franc will fall. Therefore, based on this conclusion, you sell, for example, 100,000 US dollars for 92,300 Swiss francs at 0.923. Sometime later, the rate falls to your goal and equals 0.913. Based on this data, you decide to close your deal and buy 100,000 US dollars again, but at the new rate, 0.913. That is for 91,300 Swiss francs, which is 1,000 cheaper, and is the equivalent of 1,095 US dollars. Eventually, this is your net profit within one trading day. You can trade this way a few times a day, operating with different currency pairs, either for purchasing or for selling, regardless of your initial balance. It is possible to get practical skills of working on the foreign exchange market and develop your own trading strategy by opening a demo account with UBK Markets, which does not require any actual monetary investments and does not differ from real trading in any way. Now we realize that foreign exchange market is the lifeblood of the global economy's circulation system and is vital for international economic activity. The total of currency exchange transactions worldwide is called Forex, foreign exchange market. This market was established in the early 1970s after the refusal of the Bretton Woods system of fixed rates and transition to free-floating currency rates. As a result, the major sources of revenue for banks and broker companies have been conversion transactions of their customers around the world. It has so happened that the Forex is the product of epoch and represents the evolution of monetary relations. The world is progressing in all aspects, leading to the rapid development of the financial system. Over the past decades, Forex has become the largest global financial market with a daily turnover of several trillion US dollars. This is the only global market which operates 24 hours a day, 5 days a week. Changes of Forex rates are based on economic factors which can be forecast. With a certain level of knowledge, any person can start a trading career on the exchange market and make profit today. Forex is the whole industry of the financial market that provides absolutely anyone with an opportunity to make money. UBK Markets have a great experience and have some of the most highly skilled experts in the field. UBK Markets makes an effort at giving our customers the most convenient conditions to make their plans come true, regardless of their experience working on the exchange market.